Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Benzinga Pro. I'm your co-host Joel L. Connon, along with Spencer Israel, and we have Ron Bienvenu on the line. He's managing partner for Spear Point Capital Management down in New Orleans. How are things in the Bayou?
Joel, good morning. They're fantastic down here. It's about 75 degrees, not a cloud in the sky. It's a beautiful day down here.
All right, Ron, this is the first time that we've had you on the show. Could you just give us a little bit of your background in the markets and how you became co-founder and managing partner of Spear Point Capital Management, LLC?
Sure thing. Actually got my start as a software entrepreneur. Started a couple of companies, one in 88, sold it in 91. Another one in 92, sold that in 2001. That second company, we did a lot of acquisitions globally, both private and then eventually public company acquisitions, and I really got to cut my teeth on the markets that way. And then when I sold that company, I went out and started a private equity firm with a partner, and our first deal out the gates was ended up being a hostile deal with a software company called Mercator Software, and so I learned a lot that way. And then since then, was doing a lot of private equity throughout that 10 years, and then about 4 years ago, created a more formal structure that is a hedge fund structure, and that's how I get there from here.
All right, so see, you're a graduate of LSU, so you got to be a big fan of the former Michigan player and assistant coach Les Miles. There, you're pretty lucky to have Les. All right, let's move on here. You wanted to talk in particular about three names, and they're all significant holdings for your fund. So let's start out first with IMN, Imitation.
You went right for the throat. I like that. And so, our strategy here is small cap activism. We're looking for deep value companies where the balance sheet, the net asset value in our estimation on the balance sheet, is worth more than the current trading price. Then we look at operations and say, why is the company so beat up? And then we look at ways to either improve operations or improve the capital structure, or take activist approaches to change to hopefully unlock value. Imation is an interesting play in that it actually has a negative enterprise value today of about over $30 million, which is really hard to understand considering the company has no debt.
Could you explain that, negative enterprise value?
Yeah, I mean, it's, give me 1 second, pull up the number here for you. But basically, they have more cash than market cap at this stage, and that's kind of an odd situation considering the company has, again, no debt on its books. It had about $10 million, I think, and they just paid that all off. So to give you an example, they have, according to the last filing, $97 million of cash, which is $2.63 a share in cash, and you have a market cap of $47.85 million as of yesterday. And so this company is trading like it's headed for bankruptcy, but it has no debt. It's going through a major restructuring, and we were very active in this name, going as far as to file a lawsuit against the management and board last year for self-dealing and other things. Since that time, we've been able to replace every single board member except for one, who was a latecomer to the board and is a real asset to the board. And we also were able to replace management with the help of other activist shareholders. We were quite vocal about our positions, so we're really pleased. We've got a great management team in there that's now cleaning it up, but it's a complicated story. And a lot of these companies, guys, you feel like you're screaming in the wilderness when you say, look, take a look at this company. It's really small and small in market cap. But our analysis, which we've made public, we value the company at around $5 a share if you sold off everything. So, and that's not what they're doing. So it's a strange situation. It's a great opportunity. And during this painful restructuring, which is just about behind them, they're going to emerge as a company focused on data storage with some very innovative products. They've done a couple of really interesting deals in the last few months where they bought a company that is basically a Dropbox for enterprises. It's a secure Dropbox, and it's a lot cheaper, and it's a fantastic product. And then And more interestingly, they actually eliminated 16% of their outstanding shares. A big company in Japan, TDK, owned a bunch of shares. They cut a deal with them where they returned some IP and some non-profitable or marginally profitable revenue to them, and they reduced the share count by 16%. So we think it's a really deep value opportunity. We've been buying it. It's frustrating. Like I said, we put out our paper and our thoughts on it, and there was some interest, but I think the market's kind of taken the position that we're going to wait and see how this comes out. But if you're a deep value investor, it's probably worth a look, because the negative enterprise value really makes very little sense to us, considering the company has no debt.
All right, let's move on here. Another one is GSE Systems. That's on the New York, and that's it. GVP is the symbol on that one. Give us a story on GVP.
Yeah, GVP is again another deep value asset, deep value play, and this one was less of an asset play. They manage technology for primarily nuclear power plants. And after Fukushima, the market kind of dried up, and they have very high switching costs. They have a great install base of customers. What they do is they'll emulate your power plant, mostly nuclear. They also do hydrocarbon-based power. And so think about that. So if you're running a nuclear power plant, you build one, you have to emulate your environment, and you have to test on a regular basis for various types of emergencies. So once this technology is embedded in the system, in the customer's site, it's very challenging to get rid of them. And so that's the good news. The bad news is, after Fukushima, you saw a lack of growth, and people predicted a lack of growth in the nuclear space. That's getting a resurgence, with China saying they're going to build 400 reactors, and even if you follow Bill Gates, and one of his biggest investments is really all about nuclear energy, a different kind, but it's very interesting. So the market's coming back. We got involved with this company last year. Behind the scenes, unlike iMation, where we thought the board was frankly useless or worse, at GVP they were open to ideas. We worked with them behind the scenes, and we were able to change out the CEO. We brought in a real. We're really excited about this guy. His name's Kyle Loudermilk, and he's bringing more of a technology startup attitude to a company doing about $55 million. The stock price has responded nicely. We also were able to change some board members there, bring in a different kind of skill set.
What accounts for this nice bump here? I've seen we've had a nice rally here from $1.40 and change up to the $2 levels. There been any new developments in the company?
Well, yeah, there's a couple. They signed a $35 million contract with a large power generator in the middle U.S. You think about that; it's on a company doing $55 million a year. Now it's a 3-year contract, so you're looking at, let's call it $11 million a year.
Yep.
So you got a lot of predictability and revenue predictability. I think the new management team has got a great story and They haven't really been out on the market yet, but in our discussions with them, we're excited about the energy and the vision, and they're executing. And Joel, one of the things we love to see in these small names, because we can, like I said, scream all we want about what we think about these companies, and we do. We're very open and critical when need to be. But on just this morning, there's a Form 4 filing where the new CEO, acquired 32,000 shares in the open market at an average price, it looks like, of about $1.95, $1.97. And there's nothing to us that speaks louder to the marketplace than on these kinds of companies than when guys are taking money out their own pocket and buying stock. And, we'd love to see that in iMation, but you're seeing it here, and we're optimistic. We put a price value into the public of $3.95 a share. That was assuming that the business was valued at 1 times trailing revenue, and then the net asset value on the balance sheet. We think that's a conservative valuation, and we're really optimistic about this company. They're doing the right things. They're open to change, and they've changed where they should. Let me give you one more data point that I find very interesting. Earlier this year, they announced they cut $5 million in annual costs going forward. So to put that in perspective, they spent $4.05 million in the third quarter on operating expenses. So they effectively cut 25% of the cost out of the business, and they've grown the revenue line. So it's an exciting story. It's a macro environment that's returning, not necessarily a favor, but certainly it's less negative, and you've got a strong management team. It's really a great. It's what we like to see as activists. We like to be able to. We prefer not to have a bloodbath in public. It can be sometimes entertaining, but it's not always easy. Whereas we're really happy with the outcome so far with this one.
Yeah, I would say that higher low just put in here. It has an interesting chart here, and it has a nice move up. Now your third pick here happens to be maybe the second or third best news provider on Wall Street. Number one is obviously Benzinga here.
That's why I'm doing your show.
Yeah, that's why you're on my show, right?
I'm not stupid.
All right. TST, thestreet.com here. That's something that you have on your radar here. What are you telling Mr. Kramer that he should do with his company?
Well, I will say this. Early on, I don't know if you know the story here, but we were involved with this stock about 3 years ago. And it got kind of vocal, and we made our comments known. And at one point, we were on the New York Post in the business section, front page. The title of the headline was "Blamer versus Kramer." I was.
Oh, nice! I like that.
But since that time, and then the company took some steps. And if you look at the chart, and around 3 years ago, you can see it gapped up to $3 a share. We had actually, as part of that initial investment, we even made an offer. We went upon a private equity partner to take the company private at $2.80 a share. The company rejected that. Subsequently, reinstated the dividend. Stock went up north of $2.80, and we exited a big portion of our position. Since that time, the stock has come all the way back down to the same levels we bought it 3 years ago. So we reloaded and filed a 13D a few months back, and our public statements have been they're all available at the SEC in our 13D filings about where we think the company should go. But primarily, this is how we look at it. We agree with you that they're a great company. They have some great assets. We're fans of the institutional side of their business as far as giving you a foundation of predictability and profitability. But it's hard to grow those businesses. And you guys don't know me, but at a statuesque 5'4", in Wall Street's world, if you're not growing, you really don't matter. In many cases, as a guy who stopped growing maybe in the sixth grade, I don't really agree with that all the time. But in this case, we think that you've got two sides of this business. You've got that retail side that really is Jim Cramer's piece of the business, and that is the growth engine. We think it should be the growth engine because that's a scalable business, whereas the institutional business is a lot harder to lose customers, but a lot harder to scale them. So we're hoping that they can figure out a strategy where they can, use the unique assets they have, the brand recognition, the very unique and very bright Jim Cramer, who is an amazingly intelligent guy, and he's also, in our brief conversations with him, very humble and understands that he needs to grow this business. So we're trying to be supportive but firm, and one of our quotes around here is that there has to be a statute of limitations on stupidity. You can't just keep doing the same things over and over again, as Einstein or whoever said. It's just insane. So we're hoping that they can bring a cohesive strategy that's exciting to Street. I mean, I think digital media. My background in software, I've done a lot with publishers in the 80s and 90s, and that business has been going through radical change for decades. And for a lot of people, that's painful. And if you're not one who likes change, maybe that's not the market for you. But there are tremendous opportunities to build great companies like you guys are doing. You've seen what Business Insider got sold for, and the others. If you can lead in this space instead of follow or try to maintain the status quo, there's tremendous value that can be created for all stakeholders. We're a little frustrated with the Street's strategy, at least the way we understand it, and we're vocal about and have been in our filings that we want change. We want a more aggressive consumer side of the business growth story with an asset, which is the institutional business that generates cash and can give you a foundation for stable, steady income while you create this growth vehicle.
You
So
know,
that's what we're hoping there.
the other two, I don't know a whole lot about, and I can't say anything really positive or negative. But I think on
Yeah,
this one, I have a little bit of opinion, and
I would think you would.
in my opinion, is you're not going to, his contracts with CNBC. In order for this company really to be anything, he needs to break away from CNBC and take his shtick out on the road and monetize it, and he's making too much money from CNBC to want to do that. So I'm
Well,
a little bit more pessimistic on this one.
well, one of the things that I find most fascinating, as I really became an activist full time over the last 4 years. I mean, I did deals, and a lot of them were contentious and problematic, but I was more of a deal guy. The psychology involved in these kinds of situations is staggering. It's one thing that I always knew it was there, but and so you're not the first to make that argument. Carlo Canal Group, they own 9%, I think, and he's been very vocal about that exact point. I am less pessimistic, having talked with Jim and the company, that we can't do both. I would certainly love to see them, the street, leverage CNBC better. I think it's right and fair. I think the street provides a lot of value to CNBC through Jim Cramer and the research analysts that provide research to him at the street. So I'm less pessimistic, but there are other shareholders who have been public about their pessimism on that very front. And Carlo came out and said Jim needs to decide, does he work for the street or for CNBC?
Right, right. Real quickly,
Yeah.
let's
So
just move on here. Just
yep.
got another minute or so left. You wanted to talk about the net long-term effect of lower energy prices on the economy over the coming years. You sure are getting lower oil prices here. Well, just give us your real quick take on that, and then we'll let you go.
Well, I just think that there's two types of corrections in the world, in my opinion. They're structural and cyclical. And we think this is a structural change in the energy industry as a whole. We think that the fracking industry, which, in Louisiana, I'm sitting out here looking over the Mississippi River and I see those ships and go out all the time. It's not, oh, well, this is going to come back the way it was. It reminds me of the bubble bursting in the internet phase in the late 90s and early 2000s. People would say, oh, when it comes back, we're going to do things. And I would say, no, you're not coming back. It's a structural change. And so if they fracked the United States and altered the global energy balance of supply and demand, well, they're going to frack everywhere else. And so you're in for a very long, in my opinion, period of sustained low energy prices, and that's going to impact, I think, in the long run, I think it's a positive for the economy, the global economy. But in the short run, there's going to be some adjustment pain as people really still hope for that big comeback, and I'm just not sure it's coming for a while now.
We've been
So
on
that's going to affect a lot of different types of industries and companies, and when we approach our investments, we factor some of that in.
All right. Any ideas on the rate decision tomorrow? The broad market. Any quick comments on that?
Well, I hope they do it. I think it's time to get back. That is to me a cyclical system that has been going on for too long. So I'm hoping that they'll do it. It's going to obviously, a lot. If you're looking at the energy business, factor those two things in: higher debt costs and sustained low energy prices might create a lot of opportunity on the debt side to pick up some assets, and on the short side, if that's the kind of games you play.
Ron Bienvenu, managing partner, Spear Point Capital Management LLC, down there in the Bayou, giving us some picks. Thanks a lot, Ron. We'll talk to you again soon.
Thank you, Joel. Thanks for the opportunity.